When you're in your 20s, retirement can seem so far off that it hardly feels real at all. Matter of fact, this is one of the most common reasons people make to justify not saving for retirement. Most people near retirement will tell you the years slip by, and building a sizable nest egg becomes more difficult if you don't start early. The reality is that the older you get, you're likely to acquire other expenses you may not have yet, such as a mortgage or a family. So even if you feel you're young and not making that much money, there's one distinct advantage you have over those who may be older and richer than you. And that's time. With time on your side, saving for retirement becomes much easier and exciting. In this video, I'm going to discuss the importance of investing in your 20s and my recommendations. Before we get started, I'm not a financial advisor. Everything I'm saying is based on my experience and knowledge. As always, you should do your own due diligence. I am, however, excited about all things personal finance and love to share my experience to help others along their journey. By the way, if you're enjoying the video so far, do me a favor and tap that like button. It really helps to support and grow the channel. So the financial decisions you make in your 20s are arguably more important than any other time in your life. So with that being said, guys, my first piece of advice when it comes to investing is to start. Just start now. So let me give you guys an example. Let's say that you have two college graduates with access to tax-deferred investment accounts, each earning 8% per year. Let's assume that the first investor saves $250 a month for 10 years for a total of $30,000 and then doesn't make any other investments for the next 30 years. At the end of the 40-year time frame, their portfolio amounts to $509,605. Now, the second investor doesn't invest for the first 10 years of the same 40-year period. Let's assume instead they contribute $250 a month for the next 30 years for a total contribution of $90,000. But here's the thing, despite saving more money over a longer period of time, the second investor ends up with only $375,074. Now, if you're saying to yourself, well, how is that possible? It makes no sense. The answer is that this goes to show the most potent combination for wealth creation, which is time and the power of compounding. Whether you're saving early and often, continuously adding to your investment portfolio, or staying the course in times of uncertainty, time has the power to turn small habits into incredible results. So, Jodos, my next recommendation is to set financial goals. Before investing, it's so important to understand what you want to do with the wealth you create. Create a budget and set smaller goals for establishing a plan to meet those goals. I can't stress that having a good understanding of your income and expenses is so crucial in being successful at saving and investing. I mean, it all boils down, you need to know where your money's going. For any financial goals less than 3 to 5 years, I categorize them as short-term, and this should be kept in cash rather than invested in the stock market. Market volatility is inevitable. It's the cost of higher expected returns in stocks versus bonds or cash. So I really think it's unwise to accept the risk of market losses for your short-term goals because they have less time and sometimes no time to recover at all. So while savings for short-term goals should be in cash, I recommend a mix of stocks and bonds, a growth-oriented financial portfolio to grow your wealth to fund long-term goals such as retirement or a child's college fund. Reason being is that if your portfolio lacks sufficient exposure to riskier assets like stock, then you may not generate enough returns to meet your long-term goals. My next recommendation for investing in your 20s is to max out your retirement account. And the best place to start is investing in your employer-sponsored retirement plan to earn a match. For example, if your employer has a 3% match and your salary is $100,000 per year, you'll need to contribute at least $3,000 a year to your retirement plan to be entitled to your employer's full matching contribution. Failure to make this contribution is like leaving free money on the table, and we don't want to do that. Once you invest enough in your employer's plan to receive the match, then work towards maximizing your contributions to other tax-advantaged accounts. And I would do it in this order. So first, a Roth IRA or a deductible traditional IRA, employer retirement plan, traditional non-deductible IRA, and a taxable account. Lastly, although it's not always thought of as a retirement account, utilizing a health savings account, also known as an HSA account, can provide a unique way to boost your retirement savings and protect yourself against costly medical expenses. My next recommendation, and so important guys, is to put aside money for a rainy day. Having money available for unexpected expenses, regardless of your financial position in life, is so extremely important. So allocate some portion of your income for savings to an emergency fund. This should take priority over additional debt repayments or additional investing. In general, an emergency fund should contain 3 to 12 months of expenses. If your emergency fund is starting from zero, then allocate at least 10% of your excess savings each month into this account. I recommend consider keeping your emergency fund in an online account to earn a higher interest rate than you would in your primary checking account. And as an added bonus, keeping your emergency savings separate from your primary checking account reduces the temptation to access those funds for non-emergency purposes. One important fact I would like to express is that investing is complex. So with that being said, don't try to time and beat the market. History has repeatedly shown it's not a winning strategy. So there's an idea out there that's pushed by some financial professionals and online experts alike that if you take the right approach, do the right research, and put in the right amount of effort, you can try to pick stocks that will beat the market average. Now, these gurus break it down in simple terms that make sense, and they occasionally seem to have their data back up their claims. I have to say, their pitch is appealing. They make it sound like it's pretty simple to beat the market if you have the right information and the right discipline. Unfortunately, in my opinion, I think most of it's garbage. So whether you look at the past 3, 5, 10, or 15 years, only about 15% of all professional mutual fund managers were able to beat the market. If you think about it, Joe, that's less than 1 in 6 professional investors. I mean, these are people who are trained, paid, and spend their careers looking for the best investment opportunity. With that being said, guys, dollar cost averaging and consistently buying into the market is the best way to go long term. Trying to predict the highs and lows and getting in and getting out at the right time doesn't work for most people. So I would say invest in companies you believe in and just keep constantly buying regardless of the stock price, regardless if it's up or down. And that brings me to my next recommendation, which is to make your investments automatic. Finances have a way of getting increasingly complicated as you get older. So putting your savings, bills, and investments on autopilot can really help to simplify and make things easier. But your investments, making it automatic just seems so much easier. For example, let's say you contribute $500 to an investment account on the 15th of the month for a long period of time. This allows you to diversify not only across asset classes, but time. Making equal dollar purchases over time can potentially lower your average purchase prices because you buy fewer shares when prices are high and more shares when prices are low. Dollar cost averaging is the simplest way to invest paycheck to paycheck because you don't have to do anything beyond setting up automated monthly contributions to your accounts. With that being said, in your 20s is a great time to jumpstart on your finances and set yourself up nicely for the future. Start making these changes now. The good decisions you make early in your life will have more time to compound in your favor and set you on the path for financial success. If you found value in the video, do me a favor and hit that like button and share with others on social media. It really helps to support and grow the channel. Don't forget to subscribe and turn on the notification bell as I'm posting valuable new content multiple times a week. Thanks again for watching, and until next time.